And welcome to Investing Basics Risk Profiling. So the obvious question is, what is a risk profile and why bother to do it? And the short answer to that is, a risk profile is a slightly scientific way of trying to unpack your risk tolerance and your return expectations. The reason why one does it is, unless you do it in a slightly scientific way, it becomes a sort of a very emotive process of allocating capital, often with catastrophic consequences. So the real reason is to identify exactly what it is that you are looking for in your investments, and then to align your investment profile to the assets, and that's something that we'll deal with in the subsequent video. So how to do it? There are many risk profiling tools available on the internet. Your financial services provider, your investment advisor, could also surely help you in that process. But what we've done in the subsequent slides is just put together a very quick six-question questionnaire that will help guide you in the right direction. We're not saying for a second that this is 100% accurate, but it will give you a pretty good sense of what your risk tolerance is and what your return expectations are. So jumping straight into the questionnaire, question one relates to the amount of time that you've got to invest. And there's an old saying in the investment world that it's time in the markets that is important. So question one is, what is your ultimate investment horizon? And it's important to say ultimate, and that you're not just looking at the next important event in your life, such as retirement. So if you feel that you have less than 3 years available for investment, you would give yourself no points for this question. Between 3 and 5 years, you would give yourself a score of 2 points. Between 5 and 10 years, you would give yourself 6 points. And if you have 10 years and longer, you would give yourself a full 8 points. Just jot that score down. We're going to tally them up in a second. Okay, question two then, which of the following statements most accurately describes you? And I think it's important to say that this is more to try and understand how you're wired, and it's quite a valuable exercise for you personally, quite possibly. And again, we're looking on the medium to long term. So if you feel that the statement, "I would hate to be invested in a falling market," accurately summarizes your feeling, you would give yourself no points for this question. If you accept that investment values fluctuate but that you would like some degree of stability, you would give yourself 3 points. And if you say, "I would hate to miss out on a rapidly rising market," you'll give yourself the maximum, which in this case is 6 points. Once again, just jot that score down so we can tally them up in a minute. All right, question three then is around possible changes in the capital base and possible changes to the investment strategy or the investment objectives. And the question is, when do you expect to withdraw a significant portion of the capital? Now, in our world, we would define a significant portion of the capital as, say, 20% or more. But it could also mean that you would expect at a point in the future to significantly change the investment objectives. So if you think that you might require a big block of your capital within 3 years, you'll give yourself no points for this question. Between 3 and 5 years, you would give yourself 2 points. 5 to 8 years, you would give yourself 5 points. And if you never expect to withdraw the capital, you will give yourself 6 points. And once again, just keep track of that score. Then question four relates more to the income that you would expect from this portfolio. And this is important because, you know, if you require a high level of income, then obviously that would imply less capital available for capital growth. So if you require, for example, roughly the after-tax yield on cash or bonds, you would give yourself no points for this. If you feel you require a fair degree of income from the portfolio but not quite the maximum that is available on cash and bonds, you'd give yourself 3 points. If you say, "I require very little income from this portfolio," you would give yourself 5 points. And if you say, "I require no income currently but may in the further future," you would give yourself 6 points. Right, then question five is around annual return expectations, and we've got to say this is a little bit tricky because depending on the geography you're based in and depending on the state of markets, it does have some influence on this. But really what we're trying to understand is what the floor return is that you want and how much upside you want in exchange for that certainty. So option one is you would say, "I require a minimum of, say, 2% and a maximum of 6%, for example." So very risk averse, you want absolute certainty of what you're getting, and you're prepared to forego some upside in exchange for that certainty. In this case, you'll give yourself no points. A minimum of 0 and a maximum of 10. Clearly what you're doing here is you're accepting some degree of real return being negative in exchange for slightly more upside. The third option is I would expect them or require a minimum of say -5 and upside participation up to say 20%. In this you would give yourself 5 points, and if you say I'm prepared to tolerate a fair degree of downside but for more upside, say a minimum of -20% in a year with virtually unlimited upside, you would once again give yourself the maximum of 8 points. And then the last question really tries to understand how important growth is to you, not from a principal point of view, but really how much you need growth in order to protect your earnings base. So the question is, how important is growth to you? Option 1, I don't need any capital growth on these funds as I have enough capital to live on. You would give yourself no points there. If you say I will need my capital to grow, but that growth could be quite modest, you would give yourself 3 points. And if you say I need my capital to grow quite significantly over the next few years, you would give yourself a maximum of 6 points. So take a minute now or a few seconds just to tally up your points, and then in the next slide we'll just give you an illustration of a few of the risk profiles. Alright, so if your score was less than 10, clearly you're very risk averse. We would describe you as being cautious. If your score is between 10 and 15 points, we would define you as being defensive, where you're still inherently conservative but you're prepared to tolerate a little bit more risk in order to generate return. The next one up, which is a score of 16 to 25 points, is what we call balanced, which is where a lot of investors ultimately sit. And that's really just somebody looking for a healthy balance between current income, future income growth, and capital appreciation. The next one, a score between 26 and 30, which is a fairly narrow band, is what we call moderate growth. Just a little bit higher risk than balanced, but clearly not very aggressive. And then a score of more than 30 would be what we would call a growth profile. Quite importantly, we haven't put a high growth or an aggressive growth profile in here because we believe that those profiles have slightly different strategies where one takes more active positions and looks at exploiting market conditions. Okay, so now that you've got a label that you can put to yourself, the next step obviously is to allocate your capital both in terms of the asset mix as well as the underlying investments. So we would recommend that you then watch the follow-up video to this, which is Investing Basics, Risk Profiling and Asset Allocation, for a little bit more information on how to conduct that process. In closing, we've just got to say that this video is really just meant for information and educational purposes. It cannot be seen as comprehensive financial advice, and we'd urge you to look for a professional advisor to help you before you make any big decisions. This video is proudly brought to you by Kerner Perspective and KP Fiduciary Solutions. Please visit our websites for more information.